we applaud your endurance for panels. You've had a lot of them today, but this is going to be the most interesting one. I can guarantee it. This is a team of venture capitalists, all except me. And for those who were here a little bit earlier, I told you my name is Shelley Bays, and I am part of the Keiretsu organization, which is the largest international business angel network today, 52 chapters, I think, around the world. So we deal with very early funding, all sorts of companies, agnostic of sectors. It's pretty exciting. But I have to tell you, I have always been in awe of the big guys. And they're all sitting at the table here ready to converse, and I've got the mic. So we're going to talk about a number of things. Obviously, this is focused on global ecosystems. So we're going to talk a little bit from the standpoint of venture capitalists, of different sizes and focuses. We're going to talk a little bit about some of the complexities that they see today and have some good interaction. So I'm going to introduce Pierre, who is with Tempo Cap, Ben, who is with Draper Esprit, Rodrigo, who is with Zingu, and John. Just John. Okay, so that's the group of us. So, you know, let's start in a very orderly manner, and we'll just kind of go down the row. And what I'd like to ask each of these individuals to talk a bit about is, what are they seeing today as the primary challenge facing the venture capital world, as opposed to, say, 10 years ago?
Hello? Yeah, so basically, Charlie, good question. I think the biggest challenge I see is high valuation, high multiples. Because we're living in a world of bubbles, real estate bubble, bond bubble, and obviously private equity bubble and public equity market bubble. Because usually when I'm used to buy companies at 1 to 2 times revenues, and now people are asking 10 times, I'm a little bit shocked. Or people who have 0 revenues and ask for 100 million pre-money valuation, well, that raises some questions. So I would say, and because I tend to be a little bit more conservative, you know, and so this I feel a little bit it's rather a time to sell than to buy in these days. And I feel it quite difficult, at least for myself, you know, to accept high valuation, because when you buy at a 5 to 7 times or 8 times revenue multiple company, you have to understand that you have to earn this money in the future. And if we get a downturn, which may be likely, we see more indicators, more stress in the banking system in the next year to come, you know, so I think a correction is not unlikely. When it will happen, I don't know, but my prediction is that it will happen, and then you will see that a lot of hot air out of valuation goes down, and if you buy in at 8 times revenue and 24 months later you are at 2 times revenue, well, you have a lot of work to do to get that. That's, for me at least, the biggest challenge we have. And the second biggest challenge is because the barrier of entry for technology has come down so significantly. So basically, like 15 years ago, you looked at one risk management company. Now you look at not one payment company, but 500 payment company. Or you look not at 5 blockchain company, you look at 800 blockchain company. And I think the differentiation has become much more difficult.
Great. Well, I think my answer is not dissimilar, which is, for me, it's about, I mean, I think it's great to have high valuations and companies that are growing very quickly. I think you kind of need to know what's the end point, where are they going in the future. And I think the challenge, in Europe at least, is we just need to see more companies go public in Europe. Because the problem is, in the past 20 years, our best companies have got acquired by the Americans. And the talent flows out, the capital flows out of the European ecosystem. And for me, I want to keep it in the system. And I think it's great to see Spotify go public at 30 billion, but I think it's a shame that Izatul sells to PayPal at 2 billion, right? I mean, that would have been a perfect public company in Europe. And that company would then have built an ecosystem around it. It would have done acquisitions. And that's really, I think, what Europe needs. And I think then as an early stage investor, that gets me feeling better because I know that I've got somewhere that my companies can go for an exit other than just selling out to the big US players.
Well, I think the two major points just mentioned, the excess of liquidity that causes problems with valuation, but also the fact that private placements have taken over big time. So you have a much longer stint for the companies. They're raising capital and more capital and getting bigger and bigger and makes it more competitive for us. As an emergency thing as well, I would say that when you see the big VCs like Sequoia and the others jumping on the bandwagon of ICOs, I think that's a challenge as well, because it's kind of creating an alternative route for companies to raise capital, but with a bit of a lack of discipline. So it becomes more of a problem for people who are doing the traditional VC, I suppose.
Yeah, I mean, I would echo the point around the amount of capital that's come into the market. I think the capital has come into the market in a couple of different ways. One is with new kind of highly dynamic venture firms and teams, and I think that's encouraging, albeit competitive. And I think the second way is through strategic investors and pots of capital that wouldn't ordinarily be investing in the space. And that, I guess, is more concerning because it tends to go away quite quickly. And it also really enhances valuations because the people haven't worked through cycles in those teams. I think but I think the biggest challenge we have in UK and Europe is talent, actually. And so if you work, as you scale these companies, a lot of that capital is going into finding people, and there's a huge gap in experience around really scaling companies as compared to the US as the obvious example.
Thank you. Yes, and apologies for the U.S. Picking off the great ones, but I would concur with you. I think excellent points. So I have heard that as the VC industry is evolving, that companies are taking a look at earlier stage companies than ever before, and setting the valuation issue aside for a moment because it's not trivial. But are you seeing that? Are you seeing that within your firms? I mean, it used to be, if you finally made it to the door of a VC, you were going to get big, big, big bucks. And it feels like today that line, I guess, is blurring a little bit. And maybe that is reflecting some different thinking in VC firms. So anybody want to jump in on that one?
I think, I guess the way we're thinking about it is more of an ecosystem. And so the way that we're trying to play is, our main business is direct investing at the Series A and Series B round. However, we want to be part of the ecosystem. So we want to find a way of supporting earlier stage investment. And so we have a program where effectively we are investing in earlier stage funds because we think that gives us great insight and brings us great deal flow. So that's one way of trying to sort of manage the ecosystem. But at the other end, when we look at deals, we also think about giving people liquidity because a lot of as you say, these companies take a long time to build, right? And in many cases, and John and I know this only too well, dare I say, in many cases, the syndicate in year 7 and 8 falls apart. It's a perfectly great company, but the syndicate is no longer ready to go for the next 5 years. And that's something that I think we have to change. And so one of the things that we're thinking of doing is how can you give people that liquidity so that effectively the company can then move on for the next 5 years and continue to be a great company. So that, that's how we're thinking about it.
Yeah, just to jump in 1 second on what you're saying, it's interesting to me to observe what's going on in Europe from the angel standpoint or early investing standpoint. What I see are companies have a tremendous number of opportunities, be they grants, be they investors who are also enjoying tax incentives and all sorts of things. And then these companies reach a point where those things no longer apply, but, many VCs are at a different level. And so there is this gap. There is this gap in between.
There's certainly a gap in Europe. That's what you don't have in the US because it's a much more mature market. And you have this funding gap. You're absolutely right. And it's a real issue because people are moving more later stage just in order to avoid risk. The earlier, the higher the risk, and the other way around. So this is a natural component about reflecting the poor results of VCs over the last 15 years. A lot of European VCs were not really successful. And this is so yeah, that is really an issue. So, and that's reflecting it. And I fully agree with you, Shirley. We need more early stage venture capital funds who are willing to take a bigger risk to bridge that gap between the angels, the friends and families, and then really helping the company into the next stage. And what I would also say, what's a little bit missing in Europe is that, well, we got a type of venture capitalist now who has only lived in venture capital. And we need more people who lived outside the venture capital world, meaning former CEOs, former CTOs, who went through a successful entrepreneurial life because they can add more than the pure Excel spreadsheet thinking. I'll give you an example. I met a company in Germany a few weeks ago in the wealth management space, and he said to me, Pierre, we met 25 VCs, and I was disappointed by each of them because they were not interested in my product. They just want to hear financials, made their model, came back with evaluation. And what we want is, we want people who open their Rolodex, who give us entry points into the banking, insurance sector, who help us strategically, who really challenge us. That's what we're needing, and that's a little bit missing, and this is what you really need from when you come from the angel, friends and family side to the next stage. And that's where I fully agree with you. We have a huge gap, and it's very difficult to fill it. You know, I think the European Union tries a lot with the funds. For example, I was just in Poland last week, in Warsaw. They got a big state fund. They got a lot of money from 500 million from the European Union. They try to fill it all over the place. I think they try to do it, but I guess we need more, still more to do from a government perspective in order to incentivize that.
I think there's two major points. One is the difference between London, especially, and the rest of Europe. So you have much more capital here and a more dynamic market, I suppose. And one of the byproducts of that is the pace of the rounds. So companies are raising money at a crazy speed. So if you want to participate, there's a round every 3 months. So obviously, as an investor, you say, okay, I'm going to go for the earlier one because in 3 months' time, they're going to raise again, and I'm going to be in a different level in the value chain. So I suppose that we need to think about, so if that's the case, are we really creating value in that short period? And go back to the fundamentals. I know people don't like that because it's boring and you need to look at the details, but that creates disruptions and distortions in the market as well.
I think it's funny because sometimes you really feel the gap that you're talking about, and other times it feels like it doesn't exist at all. So we've seen a trend where the Series A has been redefined to earlier and earlier stage businesses. And at the same time, the Series A round size has dramatically increased. And so sometimes that redefinition is attached to technology innovation that costs more to get to that point. So deeper tech naturally takes a Series A little bit earlier. But quite often it is, whereas in 2 years ago, a Series A was let's take a software company as an example, a software company doing somewhere between 100 and 200K a month of revenue, which is still pretty small. It's now a software company doing 50K as long as they're growing fast enough. So the right companies, there's no gap there at all. I think where there is a gap actually, and the other thing is those syndicates tend to come together around the lead investor. I think there are a lot fewer people or VCs in Europe that are prepared to actually lead and price deals. And that's one of the ways that you can kind of try to play against this wave of capital is be really bold and early and prepared to price early and bring a syndicate round and kind of trying to get ahead of it. But yeah, I'm not convinced there's a gap. I think there's definitely not a gap in capital. I think methodology creates some gaps for some companies.
How about sectors? So, there are emerging sectors and traditional sectors, and what are you guys seeing as kind of the hot spots? I mean, I know okay, blockchain and AI, but within that, because those are pretty broad categories, what are you seeing as you look out? Because you're trying to find the most interesting things at this point, and I'm just curious as to your favorites.
Okay. Okay, I start. So yeah, obviously. So I'm a fintech guy. So because very simple, I work for Deutsche Bank, and it's the only thing I understand. So I love fintech.
Spreadsheets, right?
Well, yeah, absolutely. No, but not spreadsheet. But I like the financial technology sector because that's something I really have been active for the last 15 years. So I know it, and I believe I know it quite well. And I like the whole stuff in the middle office side, which I call the dirty technology, like cloud-based reconciliation. That's what people don't like, but I feel there's a huge amount. And then obviously I like the whole trading sector because I see, especially in the crypto segment, when you look at crypto exchanges like Binance, Kraken, Coinbase, it's just like archaic. It's archaic. You see, you want to trade, you can't trade fiat to crypto, you have to trade crypto to crypto again, and you're losing at the spreads. You have these normal wallet, cold wallet. I thought, what is this? I can't even believe that this exists. So in order, if you want to really make it accessible, it must simplify, and that's why I see a lot of things happening in a moment in that sector. I'm a big believer in tokenization of the economy. I'm a big believer in blockchain. If you ask me about that, I believe enterprise blockchain solution which really helps, and that's where I believe where you need to see something where companies or blockchain companies have actually projects and really deliver and have 100,000 or millions of transactions on their blockchain. What we need there is, for example, solution which solves the translate or makes a business between public and private blockchain, and also between different private blockchain. If you're on Hyperloop, on Ethereum, on EOS, whatever, they don't communicate to each other. It's an issue, but it's a normal evolution of the system because we got the hype. Now we got disappointment, but I believe there's much more to come in that one. And then, last but not least, I'm a big believer in AI. But I was that already 15 years ago when I invested. At that time, you called it unstructured data, and it never delivered. So I think it will take still some time.
Timing is everything.
Deliver the actual results.
Venture capital in general is amazing at defining sectors, but there's no real, the definitions are so, we like to define by stage, and then we'll invest all out of those stages. We like to define by technologies like AI, blockchain, quantum. We like to define by business models, so consumer internet, SaaS, and it goes on and on and on. And so it's kind of hard, and then we like to define by sector, so fintech, agri-tech, legal tech, and. So it's hard to then pick out kind of hot bits of that. I think consumer banking has been a really hot space, and wealth management has been a really hot space over the last 5 years, and fintech as a whole. But now we're just seeing funds pop up with 2 agri-tech funds raised in Europe in the last 18 months. I think we're going to see these kind of name an industry, follow it by tech, and create focus behind it, keep going. I'm not totally sure whether that's a good or a bad thing, but it's difficult to define.
I think, fintech has been dominated for the last few years, but we are looking at health tech, and because of the level of data maturity that you can collect and act upon and create insights and interventions in a growing, aging population. And at the same token, that's why fintech was so interesting as well, because we're talking about a financial market that can be disrupted by data. So financial markets are essentially data-driven, so you can create very interesting software that can disrupt that. We have a little bit of concern in terms of AI. Everybody talks about AI nowadays, it's a buzzword, but when you then try to dig in, it's 99% statistical modeling rather than AI. So there's no element of predictability, and I think it looks pretty bad when a founder tries to pitch without knowing exactly what's behind the scenes and in terms of the technology they're trying to sell.
I think actually in Europe, I think it's really exciting. There's some really big ideas in Europe right now. And if you look at the last 3 or 4 deals that we've done, I mean, it's really been in the sort of, in the technology, what I'd call infrastructure or middleware layer of tech. I mean, blockchain is a good example. I think it's really, really early in the gestation maturity of blockchain, but there's no doubt it's going to be transformational. But if you go back to what people were investing in the internet in sort of the mid-late 90s, that's what we're doing right now. So we just invested in a business called Ledger, which basically is security for cryptocurrency trading. So it's not the trading itself, but it's trying to provide the security layer to do that. We just invested in a business in Helsinki that is building a microsatellite platform to do a network of microsatellites around the globe, which will enable close Earth monitoring and also all the data that will come out of that. So that was ISI we just did recently, and then the other one we just announced was Evenetics, which is a DNA, it's using artificial material to do DNA splicing, which if you look at where genomics are going is a pretty interesting piece of tech, right? So I think the exciting thing is there are some big ideas out there in Europe right now, and that's the exciting bit.
Yeah, absolutely. Learning, you know, at the foot of all of these wonderful companies that come our way. Is that our signal, or? Did that sound like our signal? I think that's our signal. Thank you so much. I would love to actually have continued this for another hour because it's a pleasure talking to all of you. Thank you.
Thank you.